We're back, traders. I'm Brianna Valesky with Joel Elconin. We have Sean Udall on the line. He is our tech stock strategist. Sean, how are you doing this Monday morning?
I'm good. How are you guys?
Good, good. We're hanging in there. We're gearing up for this heavy week of earnings that we've got going on. Why don't you give us your take on a couple of the tech stocks that you'll be looking at?
You bet, you bet. So, well, first of all, everybody's hyper focused on Apple, and I've kind of made my Apple theses known on this show a few times. I think if I get sum Apple up this way, if the earnings report was coming 60 days ago, it would be a shockingly, stunningly good quarter because analysts were about 20 to 30 cents below where they are now. So literally in the last 60 days, analysts have raised numbers anywhere from 20 to 30 cents on EPS. I still think they might be able to beat they'll probably still beat the number. Again, I think they would have beat by 30 to 40 cents had analysts not gone kind of crazy with all the estimate revisions. But the stock will probably not trade on how good the current quarter is. It'll trade on the guide. And I actually think if Apple basically guides in line to slightly higher, I think people might be surprised how well the stock might work. So we'll see what happens, but I'm not one to say no matter what they report, the stock's going to go down. As far as I think a lot of earnings reports that are coming this week, people are talking about Apple, Yahoo, Microsoft, and some of the big ones. Some of the most interesting reports for me actually are some of the smaller players, smaller cap techs, if you will, on Wednesday and Thursday. So names like Fortinet, names like ServiceNow. Cirrus Logic, which has been just absolutely crushed. They could be an outlier reporter, meaning, outlier to the good side. And then Thursday, you have the same thing. I'm kind of sort of mid-cap tech. A lot of those names are sort of exceedingly interesting to me, like a Proofpoint, InvenSense, JDS Uniphase, stuff like that. So, but this to me, this is actually the first week where earnings season actually gets real. We've had a lot of kind of mediocre reporters reporting thus far. Reports have been mixed, and I don't think we've seen sort of what I call the growth stock or tech stock stars report until this week, and they're going to be out in force this week.
Sean, I got a question for you here, and you made a really interesting point. You said if Apple was gonna announce 60 days ago, you'd be like really excited, looking for a bang up quarter. So you do your own analysis, you come up with your own earnings expectations, and what you're kind of hoping for is the street doesn't catch up with you. So
That's right.
Where in your thought process, were you looking for, like if you were an analyst and you were Sean Udall, tech stock strategist with an update, when would you have anticipated that 30 to 40 cents better? And now that the street is caught up with you, does that make you a little bit skeptical?
No, it doesn't make me skeptical, but I always do like it when I feel I have a big edge, right? Because I do both fundamental and technical work. So, I mean, here's the number. Okay, so I was at 260 to 270 60 days ago. Okay, analysts were at 238 for Apple. They're as of this morning, they're at 259. I'm still above the 259, but. And I could right now. I mean, there has been some new evidence. Okay, so there's been some really good new market share evidence that. And again, this is all part of my Apple thesis I literally wrote up a year or two ago, where once they started selling big screen devices, the world was going to be shocked how much Android lost sales. Right. So all this was fairly predictable for a few people. There was a lot of naysayers out there. There's been two other things. So market share has been big. Skyworks report was actually a huge indicator that the Apple number might be a little bigger. And there's been some other stuff too. So I'm probably now sort of in the 272 to 288 range on Apple. I do worry. Here's what I worry about. I worry about there's numbers now. iPhone sales 71, 73 million. Earnings estimates of 280, 288. You get the whisper number up high enough, and you got to start being a little bit nervous. But here's what happened. Not to spend too much time on Apple because there's a bunch of other stuff I want to talk about. But The stock, though, it hasn't acted like analysts have just raised numbers 30 cents in the last 60 days. So that is the difference. I mean, it did spike pretty good to 118, 120, but really in the last 6 weeks, Apple's traded flat to down. So the best thing that's happened to Apple is it went from 120 to 105, 106, right? And I think if the stock was at 120, 125, 130, I would be selling it, hedging it, maybe even taking some option short bets into the print. The fact that the stock has sort of traded so poorly for the last 6 to 7 weeks kind of has me think more sort of neutral to maybe even taking some. And in fact, my last trade on Apple was to do some pretty aggressive call spread. So it wasn't last Friday, it was the Thursday and Friday before. Apple was trading between 105 and 107-ish, and I did 115, 125 call spreads. So, and those are already working, but I mean, if Apple goes, you know the math. If Apple goes
right.
to 125, I'm maxing out, and I paid about $1.15 for them, and literally I can make $10. So, I'm out $1. If they don't work, I can literally make $9 of profit if they work. That's a great spread trade. So, but yeah, no, I don't get overly. If the stock was at 125 to 135, yeah, I would be thinking differently. But the stock isn't acting like analysts just raised estimates by 30 cents in 60 days.
All right, Sean, and we're going to get you on another time because to discuss this, but I've always been fascinated, like how the street and how analysts come up with the earnings and all the details that go into it. So we're gonna tease our listeners, and next time we have you on,
we could do a whole segment on that, and I could talk about how I do it and why my approach is better than a lot of Wall Street analysts' approach personally. But anyway, yeah, go on with
I like that.
You might want to talk about BlackBerry real quick. I'll just throw that out there.
Okay, let's talk about it. BlackBerry. Boy, all the rumors, pops and drops. What are you doing? How you sitting on BlackBerry? We're on with Sean Udall, tech stock strategist, has been on these tech stocks for a long time. What's your thoughts on BlackBerry?
At $10, I decided that it was time to embrace the berry. So, so here's what I came up with, and I wrote a note on this. And I'll send this to you. This was to my subscribers a couple weeks ago. I'll send this to you, and you can distribute to the world. I mean, basically, I think they're kind of in a can't-lose situation right now if you have the patience for the name. So they got a good guy at CEO. He's been a turnaround guy before. He's proven his mettle before. But so here's my biggest thing on Android. Okay, so the Android ecosystem is now floundering. And Android phones are a huge security risk, and it's becoming a bigger problem, especially in the enterprise. So there's really only two secure smartphone platforms now, iOS, which is Apple's, and BlackBerry's. So my thesis is pretty simple. Either BlackBerry recovers on its own and decides to unleash the Holy Grail, which is their operating system and their network, meaning if they just quit making phones and became a software company and released their OS to all the current Android makers and let pretty much anybody that wanted to make a BlackBerry branded phone make one with a secure OS that ran on their network, the stock would be a home run. It would just be ridiculous. I don't know if they're going to do that. That's what they should do. They should stay standalone. They should become a software company. They should market the OS and market the secure network. Now, other people see this. So I do believe people have been making runs at the stock and trying to buy BlackBerry cheap. So I would like BlackBerry to do what I'm saying, stay standalone. Stock could get ridiculously high to the upside, meaning like 3-4 bagger from here. If they get bought out, anything in the 13 to 15 range is ludicrous. The stock is worth probably 18 to 22, 18 to 25 on a buyout. They're trading less than 2 times cash right now, and they're not burning cash anymore. So if somebody were to come up and say, okay, I'm going to buy BlackBerry for $17.50, what you'd immediately have happen is you would start getting a bidding war because 3 or 4 other people kind of know what I know. I mean, does Microsoft want to let Samsung have BlackBerry's software and network? Does Google? Does Amazon? Does IBM? Blah, 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 blah. So whatever initial bid comes out for BlackBerry, I do believe you'll have at least 2 other companies make competing bids. I think the ultimate takeout price for BlackBerry probably would be at least sort of low to mid 20s. So from here, I mean, it's one of these things where I think for every dollar of downside, maybe even 50 cents of downside, you have 3 to 4 points of upside. Those are sort of those things I look for. The question is, you have to be patient because I don't know when, how long it's going to take for that thing to happen.
So do you buy the
line,
stock?
Do you buy the stock?
You buy the stock, or do you do the options? I mean, because you just mentioned the whole timing thing of it. I guess if you own the actual stock, then the timing is irrelevant.
That's right. So I did common. I'm also looking at, I've looked at some leaps. The nice thing is if I were to do leaps or I'd do longer dated options, I'd probably just do the 15s. And the 15s are going to be really cheap. And then, if they don't hit, you know what you're going to lose. You can lose 100% of your bet. But if they hit, the leverage on those 15s would be ridiculous. So that's what I'm thinking. Right now I'm only in common. I have not bought. I mean, for me, the stock's at $10. Okay, well, I paid, $10, $15 for various, Apple, Netflix, Google options. In a way, it's priced like an option on a high-priced stock already. So, to me, when stocks get this cheap, sometimes I like the common over the option just because, what if I'm wrong and they do get a bid for $15? Well, the 15s then aren't going to be worth anything, but it's a 50% return on the stock, right? So. I usually try to layer in some common and then figure out some option strategies around it later on.
Sean, we've got a question coming out of our chat room here. Sheldon, he's Hurt Capital in chat, wants to hear your earnings outlook for FTNT, that's Fortinet Inc.
This is a great example of a stock that it's probably not as good of a risk here at 32. Like in the mid 20s, I really liked it. I'm gonna put a thing out to estimate. I don't know if I've published my earnings estimate for Fortinet now. I do think they will report strongly and they'll be good. They are not my favorite in the security space, though. I think you have better earnings upside. So I expect bigger beats from CyberArk, CYBR, InvenSense, or not InvenSense, Imperva, IMPV, and FireEye, FEYE. So Fortinet is one of these weird, kind of a lumpy reporter. I do think they're going to beat. If I'd say they're going to beat, I think they're going to beat by let's say 1 to 3 cents, probably 1 to 2 cents most likely. And the whole thing with Fortinet is they have to have another good guide because the last 2 quarters they have reported pretty well. And the stock's gone from 20 to 32. But it's sort of like my third or fourth or fifth favorite name in the security space. It's in the low 20s, it was one of my top 2 or 3 names. But here in the mid to high 30s, they do need to really, really deliver a good number, or they're going to get killed.
Okay, what was that one phone company that we talked about? We have our phone service here.
Ringcentral.
Yeah, what's that?
Ring. That was a sweet little gem. Yeah, I actually think they'll have a very good report. In fact, they've never missed a quarter, as I told you guys.
Yep.
I think they'll have another good quarter again. But yeah, RNG, Ringcentral, and the stock has backed off. It was close to 15 again, which from where I loved them was almost but it was a 42 to a 50% move. It's back here in the kind of the mid 13s. I think that's setting up pretty good. I think that's I'll definitely be long some Ringcentral before they report, especially if it's 13.50 or lower.
You know what we gotta do, Brianna? Every time he's on the show, we gotta like Mark say, Sean said buy here. Sean said buy here. And then when you come on again, because I follow a lot of your calls, and this one just popped into my head, and and I wanted to bring it up. But I gotta touch on a couple other stocks because we've gone back and forth in emails and stuff on a couple of these stocks. And first, let's go to Google. And, I remember you were talking about it. I got super bearish on it. And I think the best thing I can say is I got lucky on my out-of-the-money puts because I vowed to cover under 500, and it did. Now it rallies all the way back up to this resistance here. They have earnings coming up. I think the car, I just read over the weekend that they're enlisting some engineers in Ann Arbor to revitalize that car. What do you buy, sell, or hold here? We hit 540 on Friday. Now we're back off this level. Do you think Google is going to disappoint, beat expectations, or maintain this trading range?
Well, like typical, I usually have a contrary opinion on Google. So years ago, I loved it. It was my favorite stock. 2012 was like my home run Google trade because I actually didn't like Apple for one of the few times in my life, and I really like Google. I think the last time we talked, Joel, I think I liked them like in low 500s.
Yep.
Right? So I said, anything around 500 or below, I basically am long the stock. Or this is when I love to do call spreads on, and I actually had that trade on, and I took it off. Between 500 and 510, I would actually be really, really bullish ahead of the quarter. The problem is it's taken a lot of the juice out of where I thought the stock could go. So I kind of thought, hey, if they have an okay to a good report, 535, 550 for sure, right? Well, it was just at 542 before this morning, right? So to me, this is kind of like a tweener. They could miss. If I were to say definitively, I do think Google will have a better report this quarter because they've had so many bad reports recently. I mean, they've literally missed 5 of the last 7 reports. So one, they're due. 2, the one thing you got to be careful with too with Google, they typically, if they're going to have a smash quarter, it's typically the holiday quarter. So there is the stats would line up that this would not be a quarter I'd want to be leaning short. I'd much rather be leaning long. But the stock is not nearly as thrilling to me as it would be if it was in the low 500. Low 500s, I'd be pretty aggressive and I'd be long heading into the report. I have no position right now. So, but if I was leaning one way, I'd say this is probably going to be a pretty good quarter, and I think people will respond favorably to it. It could end up being kind of like a Netflix, though, to a lesser degree, right? That I don't think the Netflix quarter was especially great, but it was good, and people were leaning the wrong way on it, and so the stock made a pretty nice move. I kind of think that's what Google's going to do, except just not as much percentage juice as what Netflix reported.
While we're on the topic of some of these big tech names, I want to get your take on Yahoo.
Sure. Well, so Yahoo is all about pretty much trading at the market cap of their investment in Alibaba. So there's one thing that Yahoo could do that would be super spectacular and help the stock go up somewhere between 8 and 12 points, maybe even a little more. And that's if they can, it's just all about the tax efficiency of the divestiture of Alibaba. And they can do that, by the way. They could issue a tracking stock, and there's several transactions they could do that would be tax efficient divestiture of Alibaba. If they do that, the stock is, again, you discount it, it trades 8 to 10 points higher. Now, again, when are they going to do that? How are they going to do that? Are they going to do that? I don't know. As far as core Yahoo, I'm just sort of neutral on it. I was really bearish on it. Tumblr's starting to look a little bit better. There's a Flurry. Flurry Analytics is looking better. There's a lot of little things that they've bought that kind of didn't look that great at first, and now the traction looks pretty good. So it's still a fundamentally very cheap stock, but this is another one where I was in it. It worked really well last year. In fact, it worked really well last couple of years. But at $50, I don't, it's not that exciting. It's like, okay, well, there's 10, 15% upside, maybe 20. I'd rather be in a name that I think has, 30, 40, 50, 200% upside. So I think Yahoo's okay. I'd be surprised if something bad happened and they went down a lot. I just don't know how much upside. But there is an event, if they can do a tax-efficient spin-off, you're going to see the stock go up, roughly another $10 at that if they can deliver that tax-efficient spin-off.
So, Sean Udall, TechStrat Strategist.
If you like 10 up, 3 down risk, it's probably okay. I just don't know when that deal happens.
Sean, I just want to point out to our listeners here that, when you're talking about Apple, you're talking about Yahoo, I mean, you're talking about very specific things that you're looking for, and then that's what you're basing your actions on, earning, the Apple, they bumped up the earnings ahead of time. Yahoo, if they can do this. And I think that, I think that's what more people need to do with their trading strategies. Real quickly, I have 30 seconds each on here. Do you look for a new trend in tech like wearable devices, mobile pay? I mean, I guess you'd be talking about Apple. Is that the new trend in tech?
Yeah, I do. I mean, I do look for that. I form theses. I look for that. But really what I'm looking for is 1 or 2 or 3 stocks in a subsector of tech that really are doing things just better than anybody else, and they're disrupting the space. So you bring up Apple Pay. That's a really good example. A lot of people have tried to do payments, and they've failed. And Apple Pay is going to crush. It's going to do really well. It's going to be a $1 to a $2 billion revenue stream probably a year from now. So the difference, though, is that's going to be a $1 to $2 billion revenue stream with like 90% margins. So it's going to be a big EPS contributor. But yeah, I mean, I look, wearables. I mean, wearables is interesting. The problem is we haven't really seen a really good wearable play. I would argue that GoPro has been the best wearable play, even though it's not you're not wearing it per se. Although you kind of are. You put it on various things, but in AMBA, that sort of has been the ultimate wearable device company, right? As far as selling a component into a device selling well. So, they sell stuff that goes into GoPros. GoPro stock went haywire, but AMBA's traded way better than GoPro. So, yeah, I do look for stuff like that. I do form theses around that. But wearables kind of, we need one more good product. The next good product's probably going to be the Apple Watch. I don't know if it's going to be great, but I think it's going to be good. And then that will impact other wearable names. But I'm more, I sort of more do stuff. I look for, hey, what are the companies producing the devices? What are the companies producing the software? Who's doing a better job of beating the competition? And then trying not to overpay for the thing. I mean, it's really that simple, even though it's a lot of work goes into that.
2 days of trading into the IPO of Box. Too early to make any assessments, or how you stand on this one?
Yeah, I think Box will probably end up doing way better than people think initially, and then it'll succumb to the sort of IPO blues when companies are trading for a while, people get overly enthused about them, and then as you move closer to that lockup, the old IPO lockup, the stock gets hammered. So I wouldn't be a bit surprised if Box kind of trades like Twitter did post-IPO, or again, maybe not quite as good, but like a GoPro, or various names like this where they come out, they surprise people. By the way, I like the stock at 20. I mean, I don't love it fundamentally. It doesn't really fit my fundamental criteria, but I thought at 20 there was room, and I made money trading blocks on Friday. And it's probably a buy on dip name for me, at least sort of until sort of mid to high 20s. But I wouldn't be surprised if people take Box up and pump it way, way high to a dangerous level, and then a lot of people end up losing money in the name. That's probably what I think is going to happen. And then over time, they'll have to prove the model. The only problem I have with Box from a long-term durability standpoint is that is an intensely competitive space, and they're not the biggest player in the space, and they're well-funded, but there's other companies with deeper pockets. So, I mean, Amazon's in that space. Google's in that space. Dropbox is in that space. Dropbox is going to come public later on this year. So Box has some unique attributes right now. I can't make a real strong fundamental determination on the viability of Box long term. But from a trading stock, I'm going to be buying dips at least until 25, 30-ish, and then I'll let the crazies pump it up as far as they want. And,
okay.
But it probably becomes a dangerous stock because it probably goes to a level that's not justified.
Not healthy. Finally, I know I'm really keeping you late here, Sean, but I love your take, and we've also had big discussions on Twitter. Come out, got bashed again in Barron's this week, but is trading up 16 cents.
Oh, beautiful.
Yeah, you're still sticking with your bullish thesis on Twitter.
I am. I think that it's actually one of the easier calls long term. I mean, the engagement numbers are good. The traction, the really low ad load, all that kind of stuff. I mean, as I said before, the difference between Twitter and Facebook, and I loved Facebook for a couple of years, but so the difference is Twitter is trying not to jam ads into the system. They're trying to keep their ad load low, and they're still growing 100%. Facebook basically can't put any more ads in their platform, and they've said that on the last 2 conference calls. Yet everybody still loves Facebook and everybody hates Twitter. I think that all Twitter needs really is a quarter like Facebook produced back probably about 18 months ago now, where the stock was around between 23 and 25. They basically produced a quarter that was about the same as the quarter before, but there were a couple key metrics that were just a little better. And then the bears really had to be careful. And the stock ripped from 23 to sort of like, I think, 33, 35. And it was still very viable between 33 and 35 because that was the breakout price, which then fomented the move where Facebook went to $70, right? So I think Twitter just needs a breakout quarter, and I think one of the next 2 quarters is going to be. It could be this quarter, it could be next quarter. I'm one of these guys. I don't think the MAUs matter that much. So everybody's been focusing on this one weird little thing that doesn't really matter. I've been focusing on the fact that they've had 4 quarters in a row of 100% revenue growth, which literally nobody else on the planet's doing. So, yeah, I think it's fine. I think I would like to buy more. I bought enough of it cheap, so now I want to buy it higher. So I will buy stuff higher. And I'm kind of waiting for the breakout quarter to get more aggressive in the name. But it could be this quarter, it could be next quarter. I firmly believe it's going to be one of the next 2.
All right, Sean, we've kept you on for a really long time, but we love your input. Thanks for joining us, Sean Udall, the tech stock strategist. You can follow him on Twitter at Udall TechStrat. Thanks, Sean. We'll be talking to you again soon.
Thanks, guys. Great as always.
Okay, we kept you a little
All
bit
right.
over.
You do a great job. Bye-bye.
Thank you.
Thanks, Sean.